In today's video, we're covering a topic that a lot of people are very interested in. What is a buy-to-let mortgage? Let's jump right in. But first of all, if you don't know who I am, my name's Josh Tomlinson. I'm the Managing Director of My Mortgage Finder. We are a bad credit mortgage brokerage and we specialise in helping people who have an adverse credit history. We arrange about £100 million of bad credit mortgages every year and we have a team here of over 30. So first of all, if you don't know what a buy-to-let is, this is a property that people buy. So people purchase a property to let it out. So what do we mean by that? Somebody purchases a property and then they rent that out to somebody else, another family or another person who wants to live in that property, and they ultimately charge them rent for living there. That's what a buy-to-let is. So a buy-to-let mortgage is ultimately a loan that people take out to enable them to buy this type of property. And that would be a deposit that they have plus the mortgage that they need equals the purchase price of the property that they're looking to buy. So a few key differences to note between a typical residential mortgage, which is a mortgage designed for people to buy homes where they want to live in the home, and then a buy-to-let mortgage, which is a mortgage designed to help people to buy a property that they want to rent out. So the first thing, and one of the biggest differences between the two types of mortgages, is actually going to be the amount of deposit that you are going to be required to get a buy-to-let mortgage. Typically speaking, most mortgage lenders will want around 25%, and that's pretty standard across the board. There are some options where you might get away with a 20% deposit or even a 15% deposit, but the vast majority of mortgage lenders are going to ask for a 25% deposit when it comes to a buy-to-let mortgage. That differs from a standard residential mortgage where I would say the standard would be 10%. There are some 5% deposit options though, and there are even a couple of 0% deposit options. So with that being said, you can see here that there is quite a big difference between the two when it comes to the amount of deposit that you're going to have to put down. Okay, so another one of the big differences that you will see is whether you take the mortgage out on what's known as capital and interest, which means as long as you keep up with your mortgage payments, then you guarantee that your mortgage will be paid off by the end of the mortgage term itself. Because that basically means that you're paying your interest every month, but you're also paying away an amount of the capital, which is basically the balance of the loan. So you keep up your payments and it's all paid off at the end of the term. That's capital and interest. And that's very, very, very common when it comes to residential mortgages. Now, when we look at buy-to-let mortgages, you can still have capital and interest. That is still common, but it's also very, very common that people take these out on an interest-only basis. Now, when it comes to buy-to-let mortgages, it is possible to have that capital and interest mortgage, and a lot of people still have that, but it's also very, very common that people take these out on an interest-only mortgage. And an interest-only mortgage is basically a type of mortgage where you just pay the interest payment every single month. And what that will mean is that if you don't overpay and you do just pay that interest-only payment every single month, when you do come to the end of the mortgage term, you will have the same balance as you started with left that you have to repay. And ultimately, when that mortgage term comes to an end, a lot of people have a choice to make at that point. Do they want to try and extend the mortgage term if they can? Or do they want to just pay the mortgage off and take out any equity that they have out left in the home? And a lot of people make that decision. They basically sell the home and they take out any equity that they have left. Obviously, if the value of your property has gone up, even if you've just been paying the interest every single month, then quite often they will have made a nice capital gain on that property as well. Now, if you're thinking which one is better, capital and interest or interest only, neither one or the other is better. It's ultimately which one fits your needs more appropriately. So as with everything, there are pros and cons of each. An interest only mortgage is typically going to be less in terms of monthly repayments because you're just paying the interest and you're not paying the actual loan off. The benefits, obviously, capital and repayment mortgage is if you can afford to do that and you keep up with the monthly repayments, when you get to the end of the mortgage term, then you're going to be basically debt-free on that property as well. So, like I said, lots of pros and cons of each. If you do really want to know which one is going to be best for you and your needs, I would just definitely recommend get some advice. So the next thing that we're going to discuss is how do they calculate how much you can borrow on a buy-to-let mortgage. This is actually quite different from how it is on a more typical residential mortgage. So as you may or you may not know, with a residential mortgage, they will basically look at your personal income, for example, your salary, any other income that you have, and they will basically times that by about 4.5 on average, and that will give you the amount that a mortgage lender would be prepared to lend to you. With a buy-to-let mortgage, however, they're much less concerned about what your personal income is. Basically, what the buy-to-let mortgage lender are more going to look at is how much rent can the property that you are buying, that buy-to-let investment property, how much rent will that bring in? They will then use that monthly rent they will then use the monthly rents to calculate exactly how much that they are prepared to lend to you. So just remember, when it comes to buy-to-let mortgages, it's much less about your personal income, and it's much more about the income that the potential property that you're looking to buy will generate. Okay, so moving on to the next point, even though that we've just said that the mortgage lender, when it comes to a buy-to-let, are going to focus much less on your personal income, most lenders out there, they do still have what's known as a minimum income requirement. So they might just say that you need to earn a minimum of 18,000 a year as an example, or 20,000 a year, or 25,000 a year. But basically, as long as you're earning above that minimum requirement level, that mortgage lender should be prepared to lend to you, as long as the rental income of the proposed property meets the requirements as well. And the reason that they have this minimum income requirement in place is, even though they know the rental income will be coming into the property, and that's going to be enough to satisfy them in most cases, what the mortgage lender is thinking of is, let's say the person you're renting the property out to stops paying the rent, how would that rental void be paid for? So if the rent's not being paid for by the tenant that you've let it out to, could this person afford to cover the rental payments while they found another tenant, or would they be able to afford the mortgage payments, should I say, while they found a new tenant? So that's why they have something called a minimum income requirement. There are a handful of lenders, by the way, who don't have any minimum income requirement at all. But even though this is the case, they would still want to satisfy themselves that if your potential tenant didn't pay the rent, you would have means to actually cover that mortgage payment for them. So the next thing that we're going to go on discuss is a couple of different options that you've got when you're looking to buy a buy-to-let, and you can do that by buying it in what's known as an SPV, which stands for a special purpose vehicle, or you can do it just buying it through your personal name. Now, let's talk about the SPV that we discussed a moment ago. Basically, this is a type of company that's set up exclusively for the purpose of buying and selling and mortgaging properties, okay? And it can have tax benefits, and that's why a lot of people choose to do it. Now, I'm not going to go into how and why this might benefit you. I'm just going to say it can have tax benefits, and if you are interested in that, I would just recommend that you speak to an accountant. So that's one option. The other option, of course, is you just buy it in your personal name, and that's exactly how it sounds. Just like you'd buy a residential property, you would just buy the buy-to-let property in your personal name, and you personally would own it. Like I said, the key differences here is one is owned by a company, the SPV company, and then one is owned by you personally. Key thing to consider is the tax differences and the tax benefits that you may or you may not get. Now, when it comes to the actual mortgages themselves, the differences are subtle, but with an SPV, typically you might pay about an extra 1% difference in interest rate, and it might be a bit more expensive than if you were to buy it in your personal name. Next thing, are buy-to-let mortgages for first-time buyers? Short answer is they can be. So there are some mortgage lenders out there who will lend to first-time buyers even if they're buying a buy-to-let property. However, there are also a good number of buy-to-let lenders who wouldn't be comfortable with this situation, and I'll explain the reason why. A lot of mortgage lenders are concerned that people will buy a buy-to-let property who might not be able to get a residential property due to things like not having a personal income, etc., and live in the property, which is known as a backdoor buy-to-let. So that's why a lot of mortgage lenders don't offer them. But there are a handful of lenders that will lend to first-time buyers, even if you're buying a buy-to-let property. I would just be prepared for a lot more questions if that is the case, and they would want to have a good understanding of exactly where you are going to live and how realistic that might look both in the short, the medium and the long term. Okay, so the differences in interest rates and fees that you will pay when you're buying a buy-to-let property and getting a buy-to-let mortgage, should I say, versus getting a residential mortgage, there is a slight difference between the two. Interest rates you might see as a little bit higher with buy-to-let mortgages. Probably the biggest difference you will see is the product fees that come with buy-to-lets. These are typically more expensive than residential mortgages. Again, I am generalizing here, but you will typically see that the product fees are more expensive if you're buying a buy-to-let property and ultimately getting a buy-to-let mortgage. If you don't know what a product fee is, this is basically a fee that a mortgage lender will charge for taking out that mortgage. And you've ultimately got a couple of options. You can pay the fee upfront if you have the cash to do it, which is going to be more beneficial in an ideal world because you won't pay interest, or you can add the fee onto the mortgage itself, which means that you don't have to pay it up front, but just remember you will end up paying interest on that. So, generally that's going to be a more expensive way of doing it. And the final point that we're going to cover is, can you get a buy-to-let mortgage with bad credit? The short answer is yes, you can. They can be a little bit more difficult to get than a residential mortgage if you do have bad credit, but there are still mortgage lenders out there who will be prepared to lend to you, just dependent on the type of bad credit that you're looking at, how long ago it happened, and then a few other key factors as well. Now, we do have a more detailed video on getting a buy-to-let mortgage with bad credit, which you can check out and watch by clicking the link in the top corner of your screen. So there you have it. You now know what a buy-to-let is, and you also know what a buy-to-let mortgage is as well. As always, if you do have any questions, please feel free to pop those in the comments below. Alternatively, you can send us an email using the email address in the description. So thanks for watching. Please make sure that you hit the subscribe button and you turn on the notifications for more tips on bad credit and all things bad credit mortgage related, and we will see you in the next video.